All right. So, option trading. All right. I'm Eversley. I started option trading in 2005. And it was a way to get out of my cubicle at Lockheed. And by 2008, I'd gotten to a point where I could leave Lockheed, and I finally left in 2009. Over that time, my style of trading, I learned everything you can think of in options. I got really good at every complex strategy you can think of for option analysis, all this butterflies and diagonals and iron condors, double diagonals. Got really, really good at those things, but the reality is,
let's take I-280 north.
hey, I take I-280 north, okay. All right. The reality is, if I wanted to be independent and not have to rely on a full-time job anymore, I wanted to trade for a living, I had to find a way to do it where I could get the most out of the available capital I have. And spread trading was not the way to go. With spread trading, if trades go wrong, you have to put more money into it to fix trades gone bad. And putting more money behind money gone bad is just, when you are self-employed and there's no more paycheck coming in, you can't just grab money that doesn't exist to put into trades to keep propping them up to keep from losing your money. But the directional trader, you actually need anywhere from 40 to 50% or 60% to 70% less capital to make as much money as if you were spread trading without any limits on how much I can make. Spread trading, you are capped at how much you can make generally, and your risk is actually way greater than what you can make. And with the directional trading, which is buying puts and calls, you are not capped at how much you can make. So getting a 25 to 50 to 75% return on trades is not, or even higher, is not uncommon. And during trending market times, that's pretty normal. It's also normal to see about a 70% return on some options double in value, that doubles in value pretty regularly. All right? What we're going to go over today is one of our favorite strategies for doing long trades using a Donchian channel. So it's a real simple trading plan with a buy setup and a trigger. I'm going to go to the chart and then we'll come back to this because it's a real simple strategy that's extremely profitable. All right. Okay, so we're using the example of XLB. All right, so let's take a look at this. This blue line on the chart is a 40-period simple moving average. All right. Now I'm going to open this indicator. I'm going to put everything back in so you can see what this actually looks like when everything's in place, and then I'm going to remove a few things. So I want you to fully comprehend what I'm doing. All right, the Donchian channel. With the Donchian channel, you have three sets of lines: an upper channel, the mean line, and a lower channel. Okay? The blue line is the 50-period simple moving average, and a Donchian channel is the three lines: upper, middle, lower channel. For this particular strategy, we are not using the upper channel or the lower. So I'm going to take them off the screen so we don't see extra lines. I'm going to literally remove them so they're no longer part of the picture. So I go into my indicators. And for people who we're mentoring, we provide all these charts for you. Just give them to you already pre-set up. So Donchian channel, I'm going to have the upper. I'm going to make that transparent so it's not visible. I'm going to make the lower channel transparent. Apply.
So
not visible.
The middle.
Yep. This is the one we were talking about in an email a couple hours ago.
Yeah, just figured it out.
Yep. So the upper and lower, you just can't see it. We took it out. So all we want to see. So what we're looking for with this strategy, although the squeeze is on here, it's not being utilized. All we're using are these two lines and the Bollinger Band. Right? So I'm not sure this could be any simpler strategy. We're looking for the mean line to cross over the 50 period simple, to cross over the 40 period simple moving average. The data box will show you the numbers, the values. On this day, the mean is 55.56 and the SMA is 55.69. On this day, the mean is still less than the SMA. On this day, the mean line is 56.52 and the SMA is 55.73. So this is the day the mean line crossed above the SMA. That's the setup we're looking for. What it will look like is this. So on a signal day, we call it a signal day, the day we get our valid setup, the signal day, that is exactly what you will see. All right? That's pretty clear that it crossed over. That's what it'll look like. Okay? But sometimes the previous day you're not really sure, it might be kind of close. You can't tell with your eyes if that crossed or not, so you always make sure you check the numbers. Look at the numbers in the data box and make sure if anything is close, check the numbers. Do not rely on just your eyes. On this one, we saw finally check numbers and the crossover happened on this day.
Dark blue because you can't even see. From here, I can't even see SMA because it's blue.
Well, you just have to know this one is the
Right.
SMA.
Same color
Yeah,
as the line.
yeah. So we're looking at the color. Everything is color coded. So the indicators on the screen will match the background of the data box. Right? So this day it crossed over. Now this is on XLB, which is the material sector. We maintain statistics for each of the 20-something ETFs we trade. We only take trades if it's 84% wins or higher, with the real sweet spot being 87% or higher. So if you want to narrow down your trades even more, which ones to take, 87 is the absolute sweet spot, 87 or higher. 84 or better, we trade. 87 or better is, I've done that for a few people and they haven't seen a loss, literally in a long time. All right, but 84% or better is what we trade. So we go to our statistics now. So you guys have this in the handouts and I can email this to you also. And let's go a little bigger. Here are the win-loss statistics for XLB. It is, for most of our option trades, we're either going to go one expiration cycle or two expiration cycles. So we maintain the stats for one expiration cycle and two expiration cycles. For one expiration cycles, we have 93% winning trades. Two expiration cycles, 96% winning trades for XLB. We like trading XLB because the pricing of the options are just right. It's not so expensive we can't afford the options. If you're trading DIA, one call option is going to cost you $800 for one call option. We have alternatives for DIA, but XLB is one of our favorite ones to trade because it's not too expensive. Options are just the right price. Tons of open interest and volume. The bid-ask spread is penny wide, literally penny wide spread between the bid and the ask. You can get into the trade easy, get out of the trade easy. All right, so when these come up on like this, you just grab those trades. And XLB is one of our 20-something ETFs we trade. So we look at the stats. So here are the trades dating back to the beginning of XLB, which goes back to 1999. Right? In the last couple of years we've had no losses when XLB comes up valid. These trades come up a couple times per year for this particular strategy, for this particular Donchian strategy, and we trade several strategies, long and short. So we don't live and die by just one strategy. All right? So we look at our stats. We see it is 93% wins with one expiration cycle. And expiration means we only deal with the expiration Friday, the third Friday of the month. So from the Monday after expiration Friday until the following month's expiration Friday, the third Friday of the month, that is one full cycle. So we always want to have one full cycle worth of time in the options. Okay? So all these stats are based on having one full cycle of time for one expiration cycle or two complete cycles of time for two expiration cycles. Right? We like this strategy a lot because the options are a lot less expensive with one expiration cycle. A lot less. So you can get a bigger return, percentage return on your money going 1 month out rather than going 2 months out. All right? That's why I really like these Donchian strategies. We can trade one expiration cycle. So knowing that, we check our stats. It all looks good. Then we come back to our chart. So let's take a look at the last trade that was valid. That was on 6/21/19. Well, this is all after the close. The market is closed now. Okay? You got 17 hours until the market opens again. This is very comfortable, very easy to trade type stuff. What we're going to do is look for one strike in the money option. So if the closing price that day, look at the high-low open and close over on the data box, the closing price that day was 57.67. Assuming a strike every point, we'd be looking at the in the money option, which is the 50, the close is 50. Connie, pop quiz. Call option, which strike is in the money? 57. Very good. Pop quizzes will keep coming. be alert now. Like, okay. And there's no phoning a friend. If the show's still on. All right. So that evening, ideally speaking, that evening, we will set up the trade with a limit order for the 57 call option based on that day's closing price. The next morning the market opens and then we deal with reality. But we're going to set up a limit order based on that day's closing price, which is a 57 strike. All right? Whatever the bid ask is, you put your order in for the midpoint. All right? And we have rules for option pricing to determine if it's too expensive. A big issue people had just buying calls and puts is because they would buy a call and it would decay in value to a point where it's a loss before hitting some whatever profit objective people had. That's usually because people didn't really have a profit objective based on anything that could be repeated, tested, verified by any other human, including themselves. Sounds funny, but that's true. Our profit objective is based on volatility. We do not do option volatility. We do not analyze options. We analyze the underlying ETF. How we determine the volatility of the underlying ETF will be the average true range, the ATR. And we use a 5-day, 5-period ATR. So we look at how much is this ETF moving every 5 days. Go to data box. The last panel in the data box is ATR. So on that day, 6/21, the ATR is 68 cents, 67.679, 68 cents. Okay? So what are we going to do? Our first profit objective will be 68 cents added to the open price of the ETF the very next day. So the next day, the ETF opened at 57.69. Connie or someone else with a calculator, what is 57.69 plus 68 cents?
This is wrong.
So 57.69
7.69.
added to 0.68.
0.68.
What is that number?
51.34.
How much?
51.34.
Open. Nope.
8.37.
58.37? All right.
Wait a minute, how did I do that? 57.
All right, 58.37. All right, so the day you place the order, the high is 58.01. The next day, the high is 58.15. The next day, the high is 58.07. The next day, the high is 58.11. The next day, the high is 58.58. And the target is what?
58.37.
So this trade takes 1, 2, 3, 4, 5 days to hit the first target. All right? Usually, your percentage, let's say you are risking $1,000 or $500, your minimum risk on the option trades is $500 per trade. We cannot trade these strategies effectively if you cannot risk at least $500 per trade. Got to throw a little reality in there. Got to be able to risk at least $500 a trade because you have to be able to buy at least 2 calls and at least 2 puts. So $500 per trade is a minimum risk. Unlike Forex, where you can trade risk $50 a trade, options minimum is 500. Right? So usually when the first target is hit, especially this quickly,
And a quarter of a mile.
the overall position is usually up anywhere from 15 to 40%. So if you risked $1,000 at the first target, your overall position would have increased in value anywhere from $150 to $400. When it comes to options and the market and gaps and how quickly it moves, you can't really, unlike Forex, you can't predict exactly what it's going to be worth. It could gap up, hit your target, and be like juiced up with premium. It'd be worth a lot more. If it got there slowly, it's worth less. Right? So, but usually at the first target, the overall position is up anywhere from 15 to 40%. The ones where we do one expiration cycle, you will see a bigger percentage return because the options cost less. Right? We don't really have to worry about time decay, and we're going to buy an option, it's going to go to 0 before it hits the target. The way this is all set up, we expect the price movement to overcome the time decay. The reality is, if you took 100 trades and 90% of them hit the first target were winning trades, of those 90 trades, probably 93 to 95% are actually profitable. Some trades will have time decay and be a partial loss. That's reality. And it might be a 10-20% loss because of time decay. Even if it hits the first target, you still have a time decay partial loss. But 90-something% of the trades that do hit the target will be profitable, meaning worth more than you paid. Like I said, you don't know how big the profit will be. It can vary from anywhere from 15 to 40% at the first target. Some less because of time decay. Right? After the first target is hit, and what we do, we already had an order in to sell either 1/2 or 1/3 of our position. Automatically just sell 1/2 or 1/3, get me out of that position, put that money in your pocket. All right? When that happens automatically. Because you have your order preset, that happens automatically. Then you will get an alert either via text and or email from your broker that the order executed. That is when you have to now work. All right? So that's the only time between Monday and Friday that Larry has to ever do anything with trading. Because he does all his work on Monday morning to get into trades. And until a target is hit, there's nothing else to do. So you get an email alert or text alert, your target's been hit. At that point, for your second half of your contracts, you have to put a stop loss in, a real hard stop loss now. Initial trade, there's no stop loss this time. But once that first target is hit, your number one job is to protect your profits and give yourself the ability to make more money. So to protect your profits, you put a stop loss in on the second half of your option trade to protect either 50% or 20% of your profits. The wider you make your stop, the more of a chance it will have of continuing without being stopped out. All right, so you put the stop loss in. So let's, in different words, if you paid $2 for the option, and at the first target, the option is now worth $2.60. For 50% of your profits, you would put the stop loss in at $2.30. That's 50%. Plus, they're always adding at least 5 cents more to make it $2.35 to accommodate bid-ask spread, and there's always a little slippage. Options, there is slippage. So I would make the stop like $2.35 to protect half my profits. And then each day, as there was more and more profit in the trade, you adjust that value to protect the new 50%, the new 50%, the new 50%. If the $2 option is now at $3, then 50% would be $2.50. You keep moving the stop up, plus 5 cents. Okay? Your second profit objective is 2 times what you paid for the option. So when you put that stop loss in, it's a one cancels other order. You're going to have a second target 2 times what you paid. So if you paid $2, your second target is $4. You have your stop loss. If you paid $2 for the option, it was at $2.60 at the first target. Your initial stop loss is going to be at $2.30, and you keep moving that up to protect more and more profits until either that stop loss gets hit or your second target gets hit. And this is something that went over the last meetup because Larry said we could talk about it, because he emailed me with the best problem anyone has ever emailed me about, ever. His options were tripling in value. What should he do? Larry, I love that email. That doesn't happen. That happens maybe once or twice a year when you get triples. Okay? His options were tripling in value. Get out. Put your stops up. When you're that deep in the money, you're getting close to expiration, weird things happen, okay? So when you're that close to tripling and just put your stop loss really tight or close it out. Grab your money, say thanks to all the trading gods, and you move on. Next trade. All right? Any questions on this so far? Anything at all? Steve?
Previous bearish crossover lasted at least 8 days.
Yes.
Could you show that?
So here's your bullish crossover when the mean line crosses the 50-period moving average. The previous bearish crossover...
That's a bearish crossover?
When the mean is below the 50, when the mean is below the 40,
average?
that's bearish. When the mean is above the 40, that's bullish.
Oh.
So in the trading plan it says, for the criteria to verify for the trigger, and I'll pull up the trading plan. It says the median line crosses over the 40 and is increasing from the previous day. That's the setup you're looking for. The previous bearish crossover lasted at least 8 days, and the signal day must close below the Bollinger Band. So the previous bearish crossover lasted at least 8 days. That is with the mean line below the 40 for at least 8 days. It could be in many days, but at least 8.
Yeah, I just wasn't sure if that was trigger lines.
Yeah. And we closed below the Bollinger Band, upper Bollinger. This dotted line is the upper Bollinger Band.
Right.
So we closed below the upper Bollinger Band. And Steve is starting to trade the newer stuff like now, basically. So he's learning that now. So that's perfect timing. He's been trading the old stuff for quite a while, but this is one he hasn't done yet. But is going to be transitioning to add this one on. All right, so that is basically it for this strategy. It's a simple one. The stats on these are just incredible. It's a trade that happens a couple times per year. And here is 124.19. It has to be increasing, so this one crossed over on 54.61, 54.59, and was it increasing? The previous day is 54.61. Nope, this one's not valid because the mean line is decreasing from the previous day. When it crosses, the mean has to be increasing from the previous day, so this one would not have been valid. This one, valid, crossed over, really good trade. This one crossed over. Is the mean line increasing? 58.90, nope, not increasing, not a valid trade. Would have been a good trade, but not valid. Mean line crossed over is increasing, very good trade. And I know Lenny's been trading this, and Brenda's been trading it. And Larry, you're not doing the dailies, right? Right. And you've seen these, you haven't done them live yet. Oh yeah, the weekly stuff? Focusing on weekly? Yeah. That's a good thing with the options. The way we have the strategy set up, if you get busy in the week, you can just trade the weekly stuff. What I mean by that, some of you haven't seen it. Templates, load, weekly, turbo, and some recent trades. Pull up GDX.
So you don't have a Dolce whatever sell?
A Donchian sell?
No sell?
Yes, it's the Donchian T-lines. You should have the trading plans of T-lines buy and sell. On the weekly charts, we use a squeeze for buys and sells. Here was a squeeze buy on this week. We need the candle to be colored blue with this customized indicator along with the squeeze buy signal. This is a trade that tripled. This trade tripled in value. This is a weekly chart. Doesn't matter what the markets do every day. Look at how nice and smooth the weekly charts look. There's not just big noise up, down, up, down. Weekly charts are a lot smoother, just up, down, up. There's no noise. The noise from day to day goes away. Trade signals become smoother. Trades like this happen a couple times a year, and this doubles in value. When you don't have trades happening on the major sectors, you have trades going on in the metals, on gold, on GDX here, tripling in value. Back in January, January was our biggest month for the year, where between the first half of the month, we got all these buy signals. A lot of trades tripled in value in January off the weekly charts. We caught the market bottoms basically from our squeeze buys and some other ones for buying the actual shares, tripling in value. These happen a couple times per year. That's why I was saying we really want to see a nice deep pullback, because we have not had one of these major buying opportunities off the squeeze since January. We've had some swing trading opportunities along the way, but not the major real buys. So those happen maybe twice a year. So we have a lot of selling opportunities, short-term sells, but no big trending buys. So we're looking for this market to pull back several weeks. And if things go the way we expect it to, because it's a seasonal thing, we're looking for the next major buying opportunity in the September-October time frame, meaning we expect the market goes up, it pulls back. It goes up, it pulls back. It goes up, it pulls back. We just started to pull back. So we expect it to see at some point in time the market pull back. We're going to see the squeeze go down, become negative, and turn up again. When the squeeze becomes negative and turns up again, we're going to see our buy signals happen again. And that's what we're kind of waiting on. So for that next major buying opportunity, that usually happens in the October-November time frame. So we set up now, so I was saying, Connie, to be ready for the next buying opportunity. Get all your skill set in place and be ready. When it happens, you just go. And if you're going to, and biggest moves happen from October through April. Doesn't matter whether it's up or down. The biggest moves, that's when the biggest moves happen. We don't care which direction. Just be ready for up or down. It's usually up at the end of the year. Not last year, but generally speaking. It's been an up move at the end of the year since I started trading in 2005. That last year was the first real down move. So even in 2008, we got a little rally at the end there, and then it dropped again at the end of the year after that. So, all right, let's go back to XLB and the Donchian crossover buy. I try to keep this as simple as possible to explain it in general. When I sit down with people one-on-one to go over this, this takes several hours to go over this in detail with a brand new person. And even if you have some knowledge, it still takes some time to explain it because it's trade management. And we go through in detail how to select options, which options. Everyone in here I've worked with before, except you're the new person this time. So I don't want to throw big words at you because you don't understand it yet. But once you start doing it, like anything else, it becomes second nature. Options have a little more of a learning curve than Forex, but once you place maybe 10 to 15 trades over maybe 2 months, you got this down. And I kind of handhold you basically through all of that. So I will meet with you in person and do whatever needs to do to sit down with you to get trades placed. I think we did that with you also, Lou, right? Yeah, we just met up at Santa Clara University and we just sat down and got the trades placed. We had to talk to the broker. I know, the broker was like driving us nuts here to get the account set up right, but it took a while, but we got it down. And once you get a routine down, and Brenda got it going pretty fast too, got to talk to the broker maybe once or twice also to get the account just right. But Brenda, any experience yet that you want to, any questions? So you've been doing it for a couple of weeks now. Any questions? Because you've been doing this a few weeks now. Any questions on any of the option strategies?
So for the third target,
Yep.
you said what the target is 3 times the option price?
Yeah, for the third target is going to be 3 times what you paid for the option. And you trail the stop. The stop loss is going to protect 20% of the profit, and the third target is 3 times what you paid for the option. And you just move the stop up every day if you have more profit. But you've been doing a pretty good job so far. You don't have any triples yet, but you've been doing a pretty good job of capturing. You got the internals this week, the market internals? Did you take any of those on this past week?
Yeah, I placed 1 trade, but I only make a 1 contract.
Okay, but you got it executed, you saw it hit, and then keep going. Yeah, exactly. Good. Learn small and get comfortable with it, and then as you're more comfortable with it, you add on more contracts, but you keep your risk at the same level until you get more comfortable, but make every trade the same size. You don't want disproportionate risk. Yeah, Joe.
You mentioned meeting one-on-one with your mentorees.
Yep.
I assume there's mentorees that are out of town. How do you work with them?
I use Zoom online conferencing. Zoom has been great for doing one-on-one and very small groups. I will not have a group with more than 2 or 3 people because I want to maintain that one-on-one type feel. So with 2 or 3 people, people can speak to me. Don't type into something with a bunch of people online. No, I want you to be able to share your screen. I can share my screen with you, show me what's going on, ask real questions. So groups of 2 to 3 people max. And that's how I can maintain, and then I can talk to people. Just this past weekend, or yesterday, I was actually working with someone who's in Colorado, a former Lockheed co-worker also. And he moved to Colorado a couple of years ago as his job moved, and he had stopped trading for a while, but he contacted me a couple of weeks ago, and he wanted to get back to trading. His life changed a little bit. He had more free time, so he wants to get back to trading, and we got him all in on Forex. He's just all excited now. But yeah, we spent 3 hours yesterday online via Zoom getting his Forex trading going, and then we're going to also start options in a few months also. He's actually transitioning from engineer to finance person, and he wants to actually have his trading skills down.
The other question was, you reviewed with us how you teach mentorees Forex.
Yep.
For a new person, a newbie, what we call them, would you recommend they start with this option strategy that you teach, or would you encourage them perhaps in the Forex area?
I usually like to speak with people one-on-one first to make sure they have a good understanding of the pros and cons of each one, because each has its pros and cons. If you're trading options, then you need to be available a couple of mornings a week to do something, to actually take action on your position, to get filled, to manage them. If you're trading Forex, you need to be available at certain times in the day. If you have no availability, Forex won't work for you. We're not day trading, so you don't have to be sitting up in the middle of the night. But either one is okay. There's a longer learning curve with options because there are more variables involved. Forex is very exact. What you see is what you get. Options, you don't know what you're going to get because there's more variables with volatility and time decay, theta and gamma and everything else. But either one is fine. But I think Forex is easier, and you can learn with a smaller account. And you're going to hear people tell you Forex is so risky that people lose all their money. Yes, 90-something% of Forex traders lose all their accounts within 1 year because they have no idea what they're doing. They haven't been properly trained. They're trading with no stops, and they're going to get their accounts wiped out. Absolutely. And the Forex people will tell you, option trading, that's so risky. We will. Same thing. They're trading because they don't have a methodology. They have no stops. They have no risk management. They don't. Exactly. So I make sure I go through with everyone. People tend to have a preference, but I think Forex is just easier and net more profitable. As long as you commit to each one, Forex is still more profitable as long as you commit to it. Larry?
The only thing about Forex is you can't run it in a tax advantage account.
In a what manage?
In a tax advantage account, an IRA or 401.
Yeah, generally speaking, you cannot do a Forex trading in an IRA or 401k. You have to do a Forex account in a
taxable fashion.
Well, actually, you can trade it in a corporate account. You can create a corporate account and set it up that way, which is, I personally trade in an LLC, and my LLC is managed by a corporation.
Right.
So I have that structure set up since 2006. So I have a lot of tax advantages and many write-offs.
Yeah.
So that's the way to do it to be most effective. And once you are, if you're making more than $7,000, $8,000, $9,000 a year trading, then you should be in a corporate structure because it's now financially worth your while to have that corporate structure set up if you're making at least $8,000, $9,000 a year trading, because you'll pay so much in taxes, but you can also save that much in taxes by having a corporate structure. It doesn't cost that much to maintain a corporate structure, and that's have big benefits, especially the more you trade, the more money you make. It's well worth it.
Is that both with Forex and options?
Yes, I keep all my trading accounts, Forex, options, everything in an LLC. So all my trading accounts is in an LLC. I do not trade personal. My name is not on anything. It's a corporate account only, because I don't have any tax benefits trading in my own name. I don't even have to. My LLC doesn't even have to file a tax return. Single member disregarded entity does not have to file a tax return. That's one of the benefits. It's just a declaration on my personal taxes on a Schedule C with one deduction, management fees. Doesn't have to file an individual tax return. So that's one of the big benefits also, trading in that structure. And if anyone wants more information about that, call me, talk to me. email me and I'll send you some links to that information so you can talk to the pros about that. All right, do we have any questions about anything we've gone over? I said this stuff is a lot of information and we can spend a couple hours on this, and when I meet with people one-on-one or in small groups, the first meeting is to set up their computers, and I literally want to see how you're setting it up, your charts and everything to make it right. Whether that's in person or online, we get that first meeting, get your software set up correctly. And then I want to make sure you got your strategies, a good understanding of the position management, trade management. And then the second meeting will be to clear up all the confusion from the first meeting. A certain reality. Because you're going to be like overwhelmed, you're like, and then you're going to be like, you're going to go back, it's like, what did he say? I wrote this down. The second meeting is to clear up the confusion from the first meeting. So, and it's an ongoing process. It's not an overnight thing. Options, I always tell people you have to commit for at least 6 months just to see the profit loss profile in your account. You're going to see profits and loss going up and down, and you will, to appreciate it, you really have to commit at least 6 to 9 months of trading the methodology to appreciate it and see your account grow, to see, just because you have a drawdown in one trade, that is not a loss. Each month you run your P&L statement on your account, and you will see, you might see your account negative $5,000 because of all your positions that have gone against you, but you made $1,000 in closed trades. The next month your account might be down $4,000, but you made $1,500 in closed trades. Each month you have new trades coming on and other trades closing out. New trades coming on being winners, going against you, new trades every month. There's a process back and forth. The next month you might see $2,000 in closed trades, profits, but your account is down $4,000 from trades going against you, and we've all been there. Larry's seeing some of that stuff now. We have some trades going against him, but the account every month is closing out net profitable every month. Only closed trades count. And you can run that statement on your account every month or every week in Forex. You can run it every week and see the results. And that's all that counts. So that's why you have to commit at least 6 months to seeing the trading happen and accounts closing out. Because like Lenny has no idea what a losing month is. What's that? That happens? Yeah, it's just, and some part of it is luck that you missed a couple losing trades. The losing trades you missed might be a losing trade someone else got, and vice versa. You can't be in every trade. It's not realistic. So part of it is luck, missing a bad trade or missing a good trade too. If you miss some trades in January, you missed the biggest trades of the year. That's the way it is. But then if you missed a trade a couple months later, you missed a couple losing trades. Just the way it is. So everyone's going to have different results because everyone has different size accounts, different goals. The person with a $5,000 account will not have the same results as the person with a $50,000 account. They will not have the same results as the person with a $500,000 account. They may all have a winning account, but the net percentage returns will be different, depending on how much capital you have to work with. You all do the same trades, but percentage return, if you're trading a one lot, you will not have the same returns as someone trading halves. And to get the most benefit, you have to trade thirds. First third, second third, last third is where you can triple your money. You can't triple your money trading just halves. So everyone's going to be a little bit different with risk tolerance. Any questions so far? Joe?
It's my understanding that in order to have a Forex account and also an option trading account, you need to get either special approvals for options based on experience levels, 1, 2, 3, and so forth. In Forex, you need to go to a different Forex broker.
Yes.
Do you provide any guidance to your mentorees for going through that process, sort of hand-holding?
I usually, for options, I usually recommend either TD Ameritrade or Schwab. Those are the two brokers I worked with since day one. And you can trade through E-Trade and other brokers also, but I know between Schwab and Thinkorswim, we use the Thinkorswim platform on Ameritrade, they have been good to us. They can accommodate everything we need. When there's a problem, they address it. Customer service is good. When you have a problem, key is when you have a problem, and at some point in time, you will have a problem, especially trading options. You will have a problems. You will get weird fills. When you think you're supposed to be making this much, you make like a whole lot. You need to be able to get on the phone with someone and talk to them and have them resolve it. And both Schwab and Ameritrade are great at that. You do have to go to a different broker for Forex. The people I recommend is always Forex.com. It's a simple platform to use. You can do it either web-based or download the platform. So Forex.com is who we always recommend for Forex. There are other brokers out there, but not all of them can accommodate an if-then one cancels other order structure. We did some research on different Forex brokers, and I used to think that, well, if-then OCO is pretty standard order form. It's not. A lot of the Forex brokers accommodate day traders, and an if-then OCO is more swing trading and setting up a position, and only a handful of the Forex brokers do that. So Forex.com is my #1 choice for Forex. I recommend everyone use them. And then after that, for options and ETFs and stocks, it's going to be Ameritrade and Schwab.
Great, thank you.
Lenny,
OCO, what does that stand for?
one cancels other. So when one trade executes, the other one is canceled. So if you have a stop loss at one side and a target on the other side, a limit order. So if the stop is hit, then the limit order is canceled and the trade's over. If the limit order is hit for your target, then the stop loss is canceled and the trade's over. And we do that on options. Once the first target is hit, we put in the OCO with the 2 times the option price for your limit order and for the stop loss to protect half your profit. All right. Any more questions? Anything? Becky, any questions? Because you're always the quiet one back there. All right, let's go ahead and wrap this up then for this session.